If you're looking at stocks and seeing PE ratios like 15, 25, or even 50, but you have no idea if that's good or terrible, this video will change that. I'm going to show you exactly what PE ratio means, how to calculate it in seconds, and the one critical mistake that 90% of beginners make when using PE ratios that can cost them serious money. Stick around because I'll also reveal where to find PE ratios instantly without needing to do any math. Hey, I'm Dane, and this channel breaks down finance concepts so clearly that even if you've never invested before, you'll now understand exactly how these concepts work. If this helps you, smash that subscribe button. I upload new finance education videos every week. Let's dive in. PE ratio stands for price to earnings ratio. And here's the simple way to think about it. It tells you how many years of current profits you're paying for when you buy a stock. The formula is dead simple. Stock price divided by earnings per share equals PE ratio. Let me show you an example with a hypothetical scenario. Let's say Apple's stock is priced at $150 per share and they earned $6 per share last year in earnings. That's 150 divided by 6, which equals 25. So Apple would have a PE of 25. But here's where most people mess up. And I'll show you that critical mistake in just a minute. First, let me explain what that 25 actually means for your money. A PE of 25 means you're paying 25 times Apple's current annual earnings for the stock. Think of it like this. If Apple never grew and kept making exactly $6 per share forever, it would take 25 years for your investment to pay for itself through earnings. Now, a low PE, let's say less than 5, means you're paying much less for each dollar of earnings. That could be a bargain, or it could mean investors don't expect much growth from this company into the future. A high PE, over 30 for example, generally means investors are betting on big future growth of the company. But before you go hunting for the lowest PE stocks thinking you've found bargains, let me show you the trap that catches almost every beginner investor. Here's the mistake. Comparing PE ratios across different industries. This is huge and it's where people can lose a lot of money. Look, a utility company might have a PE of 8 because it's stable but boring, with very little growth. A tech company might have a PE of 40 because everyone expects massive growth. Neither is automatically better. They're just different businesses. Let's say Netflix has a PE of 50, while Coca-Cola might be at 24. That doesn't make Coke a better buy. You're comparing a high-growth tech company to a beverage company with a single-digit growth rate. The right way is to compare within industries or against the historical PE of each individual company itself. Compare Netflix to Warner Brothers Discovery, or Coke to Pepsi. Or compare Apple's historical PE ratio to its current PE ratio. That's when PE ratios become more powerful. And speaking of powerful, I promise to show you where to find these ratios instantly without needing to crunch any numbers for yourself. You don't need to calculate PE ratios yourself. Here's where to find them instantly. Jump onto a free website like Yahoo Finance or a paid service like ticker.com. Just search any stock and the PE ratio is right there. But here are 3 bonus tips to use PE ratios like a pro. First, look at the trend. Is the PE getting higher or lower over the past 6 months, 1 year, 5 years? A rising PE could be a warning sign that the stock is getting expensive, or it might mean that investors are betting big that the company has more earnings growth on the horizon. Second, check that the company is actually profitable. No profits means no PE ratio to analyze. Your brokerage app will just show NA or a dash instead of a number where the PE ratio should be. Third, consider the PE alongside other factors. A low PE might signal a bargain, or it might be a sign of problems ahead for the company. And that's the PE ratio for beginner investors. If you want to become a smarter investor, hit that subscribe button and I'll see you in the next one.